Hi, this is Randy Finney with the Right Side of the Chart, and this is a closing market wrap for Friday, May 6, 2022. So the big question, who won the battle this week? And that is what I was referring to as D week or D-Day week, however you want to call it. Pretty much the period from after the last of the two big fangs reported. That's Apple and Amazon last Thursday night after the market close. So really, it's been a week and a day, if you will, of what I call D week. And I'm just going to say it. If I have to declare a winner, I'm gonna say it's the Bears. It is not the type of win I wanted to see. I'll show you that in a second. But with that being said, I'm sticking short. I still think the risk reward remains to the downside. I'll tell you, the Bulls put up a hell of a fight, just like the Germans did. Well, actually, on D-Day, I looked it up on what was it, History Channel website. You can go to Wikipedia, and they said, it took almost about a week to take the beaches in Normandy, and the British and Canadians, they overcame some light opposition to capture the beaches named Gold, Juno, and Sword, as did the Americans taking Utah Beach. But then U.S. forces faced heavy resistance at Omaha Beach, and it took almost a week to clear all the beaches at Normandy. So again, D-Day was not a single one-day event. It was a process. It took almost a week, and that's what we're seeing here. So again, I'll tell you what I see. Good, the bad, and the ugly. I was really hoping to see these divergences get taken out, and they haven't been. I went over, if you didn't see the video I did the other day with the analogies, and I'm going to loop back to one point of that. I checked something today, and sure enough, I was right on my guess. I'll get to that in 1 second. But here's the thick of it. This is QQQ, my big level 317.35. We took it out. There was some back and forth, the whipsaw before the Fed, the post-Fed rally, when mainly attributed to Powell being more dovish than expected. I've shared my thoughts on this before. I'm sure Powell, he has plenty of critics out there, and he's got supporters as well. And I might sound a little dramatic. I've said this before. The words that just come to mind every time I think of what he's done over the last, since shortly after the financial crisis, is what I would refer to as criminal negligence. Now, I'm sure there's some lawyers listening to my voice are going to laugh and say, Randy, that's ridiculous. But, the definition of criminal negligence refers to conduct in which a person ignores a known or obvious risk or disregards the life and safety of others. Okay, that's the definition there. And now, okay, so, maybe I'm high and mighty that I and others, said the Fed, this is going to, end in other words, the Fed was way too easy for way too long. Okay, I get it. You can't blame them for coming in with the all-out nuclear option. When COVID hit, the world came to a standstill. Businesses, the world shut down for a little bit. But it was in the aftermath, that they kept the pedal on the metal for way, way too long, and even to this point. And that's where I'm saying now, you can't really, you can sit there and argue all day long whether they did too much when the financial crisis hit, especially in conjunction with all the monetary stimulus. And we had fiscal and monetary stimulus, both the Fed and the federal government. But what I've said all along, and I'm just kind of looping back because I haven't covered this in a while, but I've said this back then. Okay, the reason that I think Powell and the Fed, at the very minimum, have been grossly negligent is the fact that it didn't take a genius or a rocket scientist to figure out inflation was rampant, the economy was on fire. They hit their employment metrics early on. They basically violated their mandate. The Fed has a dual mandate, price stability and maximum employment. and they violated the price stability. Price stability, the word stability doesn't just mean prevent falling prices or rising. It's stability. And what we've had here, we've had surging prices, inflation increasing at rates not seen in over 40 years. So that in itself is instability. The stock market, we all know what the stock market did since then. So it's anything but price stability. Now you might be saying, well, Randy, what do you care? We all made money in our 401ks, our businesses, we're all flush. You listening to my voice, myself, but not the majority of people. There are a lot more have-nots in this world than haves. Look, I'm not a bleeding heart liberal, but I do care about my fellow man, and I can tell you that, it's widely known that inflation by far hits the have-nots a lot harder than the haves. The have-nots do not have a 401k. They don't have the majority of their wealth in the stock market and in their home prices. So it was the haves, the rich, that got richer during this whole process, and the poor have now become much poorer. And that is a fact. That is not a debatable fact. It's a known fact, well known. And okay, so now, okay, Randy, yeah, that's the aftermath, but how would they have known? This is how they would have known. This is what we were tracking. Been bullish and long commodities for, well, especially since that period of time, and the inflation, the consumer price index, the rate of inflation, the primary components are energy, food, and housing. Okay, what it costs us to live, and that's home price index, rentals. In the CPI, they actually include just rentals. They don't include the price of homes. They include the cost of rentals, but that is also relevant. They look at home price appreciation in certain markets. It gets complex, but it's all one and the same. We've had, obviously, you never see housing markets surging and then rental prices dropping. They move lockstep, and I'll show you that chart in a second. And this is one that I've shared many times in the past, a broad-based commodity index fund. So if the Fed wanted real time, these, I gotta imagine these are smart people there working at the Fed, and they know, just like I was talking about, this is the clearest way to see without waiting for quarterly CPI numbers or monthly CPI reports or any other metrics of inflation that are lagged and dated. You, in real time, day by day, minute by minute, second by second, you can look at any other commodities, and what we saw is broad-based. Everything was going up: food, energy, you name it, metals, and it was persistently going up, and it was going up at a very strong rate. This commodity index, this is the Dow Jones USB Commodity Index Total Return ETF, went up 162% since the Fed, dropped the nuclear bomb, pulled the nuclear option on the markets, and it was clearly visible. So, what point? Here, in the economy too, every metric, employment, Fed hit their employment mandate, but they just kept the pedal on the metal. And he pivoted. Powell started pivoting in November, but when he pivoted, guess what he did? He pivoted in rhetoric, not action. There's a big difference of saying, I'm going to raise interest rates, I'm going to pull them, stop the quantitative easing, than actually doing it. And so what happened is, well, inflation continued. And then, of course, DC likes to blame Russia and the Fed likes to blame Russia. But that wouldn't have happened if they would have, started, I'm not saying put the hard brakes on, just stop take your foot off the darn accelerator. So anyways, you can see I'm very critical. And it was clear. It was clear in all commodities. You can look at oil. You can look at each and every one. We all know that. I'm not telling you guys anything you don't know now, but again, it was there. It was clear as a bell. It was an unrelenting, unabating rally. We had a little divergent high there, as I highlighted, a little correction. We went up again. It's gonna come down soon because now they're starting to put on the brakes, but way too easy. And that was the interpretation of the Fed's comments the other day, especially with Powell's taking the possibility of a 3/4 point or 75 basis point rate hike off the table. So we'll look at that. You can look at housing, the housing market. This is, what did I pick here? I think a 5-year. Yeah, I think I did. Yeah, clicked on 5-year. You can find this anywhere, and you can get this same thing with the rental market. And again, this was COVID right here. Boom. Early 2020, and everything, including the things that have the biggest impact on the rate of inflation: the cost of housing, rentals, and of course energy, food, all other things. And so that is why I believe the Fed has been grossly negligent, and even at this point are. And you're hearing more and more criticism, and I'm sorry. I just wanted to get that out of the way. Um, and and as far as the the statement I made earlier about the definition of criminal negligence, it also plays into the fact that people see what happens is a lot of people are hurting right now, hurting bad from this inflation. I don't mean to sound like a politician again. That's not my thing. I'm not a very political person. Have my leanings one way or the other, but again, people are hurting financially, and in a recession, which is by almost just about everybody agrees now, it's almost inevitable. The chances of a soft landing are virtually nil, and so we're going to have a recession. To me, it's a matter of, do we have a recession or a depression? That's it. I mean, I really don't see any other way out of this, and I don't think most people do. So now what's going to happen? People are going to die from that. During a recession, especially depression, people lose their job, people commit suicide, people turn around, shoot, go do the whole murder suicide thing. People fall in hard times, start drinking, and so that's where, again, this was all avoidable. And I know I sound probably, it's like a rant, but again, it was clearly avoidable. And to sit there up until this point, just recently, starting to in 2022, that's when we got our first rate hikes. That's when we actually started to end the quantitative easing. It's amazing, truly amazing. So all right, let's talk markets. All right, I'll get off my high horse now. Just wanted to give Powell one last punch, because I still can't believe that they're not putting the brakes on this inflation. It's the thing. I don't wish ill on the economy. I've been bearish and short since the highs in this market. Swinging the rips and dips, but persistently bearish. And I don't wish ill on the economy. I don't want friends and family out of work or worried about their job or watching their house price go down, the price of their home 30%, or their investment portfolio. All right, so back to the markets. That's it. So QQQ. It was somewhat of a stalemate this week. Again, the bulls put up fierce resistance, but when I go by this chart, the bears won because they're down below there. They still haven't taken out this divergence, and I cannot impress this enough. And the word I like to use is pivot and be flexible. As an active trader especially, I will turn on a dime. I went home. I took home my shorts this week. I plan to get a lot shorter if what I think will happen probably now next week happens. I mean, we had a down week, don't get me wrong. We won in that aspect, but there's still the possibility, and whatever the reason is, whether it's PPP or the PPT plunge protection team, or it's just some positive economic report or something on the it could be any number of factors that cause a market to pop. And if that happens next week, this is why I do these videos in advance, you have to be prepared. By the time I get a video out, it's too late. If they can pop it back above, and the bulls can regain 317 with conviction, and also take out this downtrend line right there, they still have a lot of work to be done, and that's why I'm comfortable being short. I don't think we're going to see this in a very short period. If that happens, if we're going anywhere at or near or even above the all-time highs, there is a mountain of resistance ahead, major resistance. The 200-day moving average, price resistance, other key moving averages, indicators like this one I went over today earlier. You have the line right here I have on the PPO, and the PPO signal line, the white line is above, the trend is bullish. It was a bullish trend there. When you're below, the trend is bearish. When you're above, and again, it's a great swing trading tool. It's one of many things that go into my analysis. Right now, we're clearly bearish, but there's the potential for the bulls to bring that up. First would be a bullish crossover to confirm the divergence. That would be a check mark for them. Of course, they'd have to, and it would coincide with a break above, regain, if you will, of that support that was taken out this week. So if that happens, that's another check mark for the bulls. And so forth. And if they take, if they can move the PPO and cross it, the signal line crosses above that red line I have there, another check mark, so forth and so on. As of now, we don't have those check marks. Those are potential bullish developments. They could happen. They could happen next week. They could happen 3 months from now. Something to watch for. Although if it happens 3 months from now, the bulls need to turn it up here soon, or they'll probably take this divergence out. And if and when, which I still favor, the bears take out the divergence by taking the PPO down and taking out these previous lows, and then the RSI as well, that's a massive check mark. And at that point, we're already going to be at or below my second target on the weekly time frames. Remember, we came very, very close. These are the weekly targets. Right here, we'll fix that. And something funky happened. Give me 1 second. Okay, I fixed it. Here we go. All right, so I mean we're within spitting distance, or we came within spitting distance of my second target. We had a low of 305.11. My second target I've been referring to as 299 to 300 in that range. So when you come down to 305, you're talking 5 points within on a 300-point security. So you're talking just over 1%. So for all intents and purposes, you can consider that hit, but I think I'm going to hold out for now. I think we'll see more downside, and we should know next week. I thought we might get a more clear sign this week. If we do get it, I suspect we may just come on down and waterfall down right through T2 like it's not even there, with very little, if any, reaction, and come on down and then hit my third and possibly fourth targets in pretty short order. You remember, you have the trend lines as well that come into play. So that's my final target zone. At that point, I will be looking to cover all swing shorts and move to a bullish bias if the charts confirm at the time. And they tell me that's, again, and by the way, if that doesn't happen in the next few weeks or next few months, and these divergences play out, and we start to rally up here, well, hopefully I'll pivot sooner than later and recognize that, and I'll certainly communicate my thoughts to you. And then I'll be looking to revisit these targets again later on when it, if it takes to the end of the year or even sometime next year. I still favor them being hit this year, and if things play out the way I think they do, they'll be hit sooner than later, taking almost everybody, just about all market participants, from what I've gathered, by storm. There's been some people that are starting to recognize, well, something's going on here, but all I hear from the majority of pundits out there is that they're bullish, they're looking to buy, they're looking to add to positions or hold on to what they have, thinking this is just an adjustment period. And I think they'll be, if the dam breaks next week, they'll probably be stopped out, or have inflicted a lot of pain if they start trying to continue to try to buy on the way down. Because remember, if we take out T2, it sharply increases the odds of my next two targets getting hit, and including my final target there, which would be about a 42% drop off the high right there. Okay, so the NASDAQ, I showed you a pretty clear break of support. Here's the S&P 500 SPY. We're on a weekly chart. The yellow line is the one, the big level I had. It's about 415.50, and so we did close below it. So that's why I'm giving the check mark to the bears. They didn't take it out by a lot. In fact, they're barely above where we closed last week, or barely below. I'm sorry. You can see that there. So, but a breakdown is a breakdown, right? Support is support until unless broken. This is support that's broken. That's the level I had. We closed at a lower low this week. We got halfway down to my second target. And most importantly, although we have those divergences that do give me some pause, or could play out and cause me to pivot quickly, I don't see anything, and I'm struggling for it, looking for something that looks like a bottom. And that's what I don't see. In fact, all I continue to see is typical bear market action. Rallies getting sold into, even if they're very powerful, big daily swings in both directions, that is indicative of a bear market and not of a bottom yet. I haven't seen any evidence of a bottom. I showed you guys evidence of what I think could be a possible potential top in natural gas today. That's what a potential top looks like. I don't see any potential bottoms yet in the market. I'm looking for bullish reversal, bullish candlestick reversal patterns, things like that. And look, I haven't touched this line on the daily chart. I've had my resistance at 411.13, and look at where we closed. Let me click on it and say The close today, 411.34. Okay, you're talking 30 cents, roughly 30 cents on a 400 point security. That is almost exactly, and that's why, like I said, I'm not crazy about the close. I'm not giving it. I'm still saying there's one last beachhead to take out. All right, that's the way I'm looking at D week here. It's going to be extended. I thought we'd go in. The Bears could go in and have a relatively swift victory. But again, I got to give the Bulls credit. They came in and they've been defending this level hard. They're fighting for their lives here. That's the way I look at it. Big technical level. And look, and that's a doji, by the way. If you can't see it, it's because it's such a flat doji. That's where we open and close right on my 411.13-ish, just above 411 support. So that's the big level, and you can see twice we've cut under. So really, and like I said today in the earlier video, we have to take out the previous lows. You're never going to go lower until you take out a previous low, and so we dip down, and so that becomes a level to watch next week. Now it's about 485. But if you notice, I've been moving the bar down, all along. I had the bar right here before. This was support. We had a little false breakdown, whipsaw, broke it again, got back above it, but then once broken, that was it. It became resistance. Boom, boom, boom. We're stair-stepping our way down. This is the current range. We had this range before, and then this was the range, the topping pattern. So the S&P 500 is stair-stepping lower. To me, it's very clear. I mean, that's the definition of a downtrend, is security making lower highs and lower lows. Just need to go out and take out, solidly take out these lows. Intra-week, we flirted with it, but this is what we call a stick save. They didn't get back above, but they got back on the support, which is basically the same difference. It would have been more bullish, obviously, to put a solid close above there, but the Bears failed to take it down and close the week below 411, right? So that's it. So the NASDAQ 100, fortunately for me, that's where I'm trading, and it's doing better for in shorts than the S&P 500, and the other one, of course. Oh, and that one's looking pretty good. IWM. I made it very clear since I started shorting the market back in with swing and trend positions back in November, when the NASDAQ 100 and small caps peaked, that those are my indexes, not the S&P. I didn't expect the S&P to fall as much because it's chock full of steady Eddie dividend stocks and financials and other things that have held up. But this one looks good. So we had the main topping pattern on IWM, over a year long topping pattern with a false breakout, aka bull trap, followed by a breakdown that set us up in this range. That key 208 level was taken out, multiple tests and failure, and finally we broke it and back tested it recently. And you can see I have two lines. I have this one here at about 191, and then this one here, and that one's at about 188. We're below both of them, so we're just walking our way down. Yep, you can still the potential divergence, but remember, we've had this so far. We've had the hook, or the kiss, where the PPO was poised to make a bullish crossover, just like it was back in this same time back or comparable technical posture back in 2008. It was actually in September, what I showed you in the video yesterday, and now it's pointed down again. And so that is a momentum indicator, and that's telling me that there's still a good chance that the Bears will be able to foil this potential big divergent low. That's why it's full divergence, meaning both the PP and RSI, but unconfirmed. And so I see no reason to cover those shorts. We're below. That's a check mark this week, at least in IWM. Not so much kind of a question mark in SPY, a check mark in QQQ. Not the best, but a check mark nonetheless, and a check mark here in IWM. So there you have it. Those are my thoughts. And again, the next week they do this, boom, that's going to be bullish. And but this is what I'm expecting. Now let me show you what I had alluded to earlier. Let's go to the chart that I gave you the other day, yesterday in the video, when I used showed you the comparison or the analogy between 2008, really going back to the top. We're going back a year leading up to the top, and that was in October 2006. This whole period, I won't go over it now, just check that video yesterday if you didn't see it, but the similarities to me are uncanny. It's almost too uncanny, and that's the problem with that, and that might sound a little wishy-washy to you, but almost by the time I recognize a perfect pattern that has played out a certain way in the past on a security, and then I point it out, that's about when it stops working. So look, that tends to happen almost more often than not. When wow, the comparisons are spot on. Again, it's that, but unfortunately, that's not enough for me to go long and bet that just because it happened back here, that it can't happen again. Again, those technical analysis is all about identifying certain chart patterns and price action and volume and characteristics in the market, and looking back and seeing what's happened when the market or a stock or something had the same type of action in the past. In other words, those are our bullish and bearish chart patterns, trade setups, things we trade like falling wedges and head and shoulders patterns and cup and handles and all those kind of different things. That's, they work not every time, but more often than not they do. Especially if you're patient and you identify and apply the right criteria to the pattern and don't dismiss what doesn't fit and try to make it, you don't try to force a pattern just because you really want to see it. Don't try too hard to make it work for you if some of the things are saying that pattern doesn't meet. And that one example is a head and shoulders pattern. They're one of the most recognized patterns. Traders point them out all the time. That's when you get something like this on a stock. You have a left shoulder here, then a head, a right shoulder. But one of the things a lot of traders don't do, and I've talked about this over the years, is confirm with the volume patterns. You want to see increasing volume on the formation off the head as well as a right shoulder, and then ultimately a break of the neckline is your trigger. But if you don't have the volume patterns, then there's a much lesser chance, because just about anybody can look at anything, and that may been a head and shoulders pattern, probably was, and it did play out. But I'm just saying that's one example. Okay, here's where I'm going. Long-winded here. I just wanted to get all this stuff out to you. So you've probably heard me say it, and quite a bit recently, because we've been in what I still believe to be early bear market action. It's not technically, we cannot say that yet. We haven't dropped enough. But you guys remember I was getting pretty bearish back here and warning, saying the market could break down and have that meltdown moment. But it just, it held the recent lows, it put a double bottom, and the divergences back then did play out. So you got a big rally instead. That's because the bears, it wasn't time. They weren't ready. There were just more buyers. Say what you want about it. There were just more buyers in the market at that time than sellers. And they bought up that divergent low, and they bought up that successful defense of that previous low, and they rallied the Qs 17%. All right. So now we have a similar divergent setup, although the divergence is not confirmed. We've now taken out those lows. But what I was warning back here, and I've warned this from time to time when you're in correction mode, or even in rally mode. If the hat was flipped and I was bullish, we were coming off a big correction, off a bear market, and everyone else is bearish and I'm bullish. What I say often is the market, it's vicious. It's vicious, especially if you don't know how to engage that beast. And what the market loves to do is trap. It loves to trap in a bear trend. It likes to trap longs. So all the longs that have held their Apple and held their Microsoft and held their SPY, QQQ, whatever, they were sweating when we were down here. That's the biggest drop in months. Got a little reprieve. They thought it was over. It came down again. So they had strong hands and they were rewarded. And now they're sweating once again. And at this point in time, they're probably, because as time goes on, look where we are right now. Here's, NASDAQ 100 is trading where it was today. It closed the day where it was. I'm just grabbing back here, back in the end of 2020. Okay, so we, over that period of time, everybody was profitable from that point, but they're all back to where they were back here, really around that consolidation period after the big first leg up in COVID. And if they take that out, that's a big level. That's going to be bearish. Okay, now where I'm going with this is, so there might have been a few that threw in the towel and got stopped out, but for the most part, those that held here, they're strong hands. You got to give them that. But they're sweating it, and there's a lot. Remember, there's always a infinitely larger amount of longs in the market than at any point in time than shorts, especially in a bull market. This is still, by just about every metric and definition, still a bull market. So Just take that one on face value. So they're mostly longs, but they've got to be worried here. And then you have the other people. You have the people that say, "Yeah, you're making a good case, Randy. I want to short this market, but I'm waiting for bulls fought too hard today, so I want a pretty clear sign that we're breaking down." Okay, so here's what the market tends to do in those situations: is a big fat gap down, and those big gap downs come. Well, you had a couple here. All these shorts got squeezed out, up, finally threw in the towel here. All the longs, the dip buyers that were getting burned here, figured about at this point they thought, oh, it's safe to get back in the water. Oh yeah, that was a big correction, buying up. I should have listened to Kramer or whoever and loaded up on stocks back here. But guess what? Then they got trapped, and they got trapped in this trading range, and there was a big gap down. And they said, oh, okay, maybe I shouldn't get in. I'll just sell when I get back to where I was recently. Guess what happens? Another big gap. Uh-oh, what's happening? I'm just dropping. Okay, at this point now I just want to get back to here. Nope. Then you go into trading range, you drop down. We haven't had a very big gap, very big noticeable gap lately, but this is the perfect time for it to happen. So that whole D-Day kind of big second, third wave, or primary wave 3 down. I'm talking about Elliott wave counts. If it plays out like the last bear market, you had a 3 wave 1. That's not a arrow tool or a line tool. 2 up, and this could be part of 3 down. So far, it fits the bill. Look, this is a weekly chart, nothing but red sticks. That's impulsive selling. Not a single green candle, including this week. This week's over. So if this is this was the start of a much bigger drop that's going to take us down, and that's why I think we can blow by my second target if we can just have a big down week next week. It should open the door and take us down to some of these levels there. Okay, so now let's talk about that again. So that would be a beautiful situation for me being short. Sorry to speak, to my what I want to see. If we can gap down, it's going to be painful to me if we have a big gap up, and there's nothing I can do. There's not a stop loss that'll trigger. There's not an option or a hedge I can buy between once the futures stop trading tonight shortly, and then Sunday night when they resume. So I'm rolling the dice. Obviously, I pared back. I took some profits before the close today just to lighten up over the weekend, but I'm taking those equity short positions home. And as you guys know, I'm still diversified. Short the natural gas that we entered today. I'm holding that one because I've got the more aggressive targets, long gold, treasury bonds, and then other miscellaneous things. So this isn't the only one trade, but so that's it, guys. I just want to say that's something to look for. And if we do gap down on Monday, what it does, again, it traps longs that were sweating and not so happy how we closed today, and say if we go down anymore, but then if we have a big gap down. Now I'm talking the big gaps, the kind that make you, if you're long, not want to sell. A 3+% gap down. It would be a beautiful thing for the shorts because those longs are going to be trapped, and they're going to say, okay, that's it. Reach my pain threshold, but I refuse to sell. We gap down 3. Now we're down 5% on the day. At this point, let's say sometime on Monday, and they're just waiting. You know what? If we could just get back to where we were last week, then I'll sell. That's the mindset of a trapped long, and that's what makes bear markets so vicious. They don't give them that exit, and finally they're forced they all start to capitulate, and it also denies short sellers. I like to be a lone bear. I don't want other people to tell me. I really actually sometimes close positions. I'll go that far when I start hearing the folks on TV come out and they're all short and bearish, and everybody on the site that my subscribers all say they're short too. I do my job to tell you where I'm at, and I know a lot of you guys value my analysis or you wouldn't be here. Hopefully you use your own, and there's many times that I'm wrong and you're right, and that's great. But what I was getting at is I like a gap down, because when the majority of shorts, especially the institutions, are denied, they don't want to short. If you gap down 3-4% on Monday, and then and from there you just drop, and it's another 5-6% down day, one of those big waterfall sell-off days. Nobody wants to short when you're down that far. They want to wait for the bounce back, and when the bounce back never comes, that's a good thing. Why is it a good thing? You say, well, short sellers, they're going to push the price down. They're selling, and that push the price down. Yeah, but if there's too much short interest, I always say this: short sellers are the only and I mean this, the only guaranteed buyers out there in the financial markets. You can have a long side only fund that can only buy, and that's the majority of mutual funds are long side only, and a lot of pension funds do mostly longs or all longs, and they may be bullish, planning on buying, but they don't have to buy. Something can change their mind. You might be a foaming at the mouth bullish bull on Apple right now, or Amazon, and saying you're going to buy it, and you're going to buy it next week, or you're going to buy it at this price. But if something happens, you don't like it in the market, for whatever reason, change your mind, you don't have to buy. Unlike a short seller, they must. You short a stock, you have borrowed shares that do not belong to you. They belong to somebody else. You have to cover that position at some point. That's a buy to cover. And so the big drops come when there's not a lot of short interest in the market. If you have a high short interest, then you get another drop, and you get a wave of cover, and that may have been what's happening the last few days. Maybe there were a lot of shorts covering, taking profits, and hopefully they've cleared out. And there's no way to get real-time short data. It's usually lagged. You just kind of have to go with the ebb and flow. So, all right, so on to that, and then I'll wrap it up. I know I'm kind of getting long-winded on this one, but I just want to give you my thoughts before I head into the weekend. And of course, I had my little Powell rant the other day because I just can't believe that after making such a mistake, how he's still not still has an extremely accommodative monetary policy, and that is depending where he has short-term rates as well as long-term rates and where the rate of inflation is. Okie dokie, this is what I was going to tell you. So I suspected, remember I was focused on this period. This is the chart from 2008 right here. We had an almost identical pattern, how it played out with a series of 3 divergent highs with a big almost blow-off type top, and that was the top. Even this period was similar. I already went over that. That was comparable to that 17% pop in the NASDAQ we just had after the first divergent low. We had the divergence extend, again all covered in yesterday's video. PPO was starting to turn up, looked like the bulls were going to get that big divergent low and then rally things up, and I can tell you there were probably just as many bulls back then as there are right now in this market. Again, we have different fundamentals going on, but it doesn't matter. Technicals matter to me. And so here's what I wanted to go. So I analyzed this, and I got real granular there the other day, and I showed you that this little pop right here, where you undercut, you had the previous low, double bottom low, 2 successive lows in the NASDAQ 100, and then you took it out, and that was just before an FOMC meeting. The FOMC meeting came. It took it down that low intraday. That was the whipsaw, the false breakdown. Again, don't short a breakdown that occurs right before a big Fed meeting. There was a financial crisis just starting to unfold at this point. Fed didn't really do much, just like this time around, but the market, once it was out of the way, you got a relief rally, but that rally was faded right after, okay? Guess when that stopped? Guess when that week ended? This candle right here. Here, you can see, nope, hold on one second. Okay, my apologies, guys. I realized that screen recording software was not capturing all of the chart I was covering on. I could see it on my desktop. You couldn't see it. This is it. So that was it. There was the pre-Fed whipsaw that took us down through the lows. FOMC went that low. FOMC meeting the next day. Big pop from low to high. It was a 10% rally, a little bit bigger than the one we just had, and then all of it was faded. And the bulls did the same thing. It was a battle between bulls and bears. It was a key technical level. Bulls did not want to give that level up. It was important that they didn't. Bears wanted to take it out. And again, I'm just speaking metaphorically, buyers and sellers, supply-demand dynamics. And so guess what happened? Look at these crosshairs. Look at the, as I put the crosshairs on the dates right here, it should pop up. I don't know why it's not. Hold on one second. Oh, because I'm so zoomed in. Here we go. I got to zoom out a little bit so it'll pop up. This right here, that was the 29th of this one right here. We closed. That was the 26th of September. That was a Friday. We closed right on that previous low, tested the lows again, but didn't take them out. And then see this giant red candle. I'll zoom in. That was the 29th of September. See that 3-day void? I checked it, of course, just to make sure. That's a Monday. That came. That was the spark. That was it. The bottom fell out. You don't see it here. That's when the market plunged. It had one of the biggest drops in history, really, in over such a short period of time. So again, it kind of sucks that it's so similar. But again, let's just see what happens. And more of it's what happens with that gap down. We had that big down day right there, and that was a Monday. And then there was a little, they tried to kick it back, and then history is written again. I showed it before. We didn't. The market kept falling. Had a little rally back in November, a nice tradable, and I love to trade bear market rallies. That put in a wave 4 up, and then there was the final wave 5 down into the end of the year, and then double bottomed really around March 2000. So I just wanted to point out that that's what happened. The market kept everybody guessing. Nobody wanted, bulls nor bears wanted to do too much before the weekend. And then when Monday came, the drop, I'm measuring it there, but just eyeballing, if this was a 10% move here, that had to be a one-day drop of well over 5, 6, 7% right there on a Monday. So let's see what happens, guys. Anything is possible. Again, financial conditions are completely topsy-turvy. We are in a strong economy. It's actually too strong right now. But with the Fed just embarking on a tightening cycle, or back here, you were in an economy that was turning, that was softening or deteriorating rapidly, and the Fed had just begun an easing cycle. So, but again, it's technicals. This time around, the headwinds, although different, are still headwinds to the market. We're looking at the first and most aggressive rate, or what will probably prove to be the most aggressive rate hiking cycle in decades, and possibly ever, by the Fed, based on the projections. And still, what we've seen, even though Powell took off the 3/4 point, he's still coming up hiking in half points. They haven't done that, and gosh, it was a long time since we had a 50 basis point hike. All right, I'm going to wrap it up here. Takeaway is, like I said, the S&P parked right on a support level. Didn't really show me what I really was hoping to see, and I do think we'll know next week based on, again, everything where we're at. We're still right on key support. You really don't flirt with key support like that for too long. This market's probably going to break one way or the other. I still think it's to the downside, but I will pivot without a doubt if the market convinces me to on Monday. I'll also do it. I never do an all or none in a position like this. I will scale out, and I will communicate my thoughts to you. I'll get a post out to you guys in the morning if anything big is going to happen. If we're going to gap down, everything I just said now, I would stick to. I would short that gap. I wouldn't wait for a kickback. I think it will be built on. I think if we gap down, I don't think the bulls are going to pull another stick save. I don't think they'll do it. And if they do, that's what stops are for. And what I like to do is I'll stagger my stops and set them above key technical levels that should be met with selling if we bounce back into those resistance levels. And so at some point I'll have layered out of shorts and possibly back into longs. Probably won't be a one-day event, could be. Otherwise, I plan to add to my shorts if the futures tank on Sunday night and look like they're gonna look like we're gonna gap down on Monday morning. I will be layering back into, because again, I don't have overnight risk. Once the futures start trading on Sunday, I can set stop loss orders and I can go to sleep. I can walk away from the computer, and I hide those stop loss orders. I always check them hidden, especially during the after hour session, because they'll see if you're trading enough contracts at NQ, they'll come and get it if they can. Fortunately, Interactive Brokers will allow you to designate a stop loss order to be hidden. So if you hit stop price hit, that boom, they send it immediately to the exchange, but the exchanges don't see it. All right, guys, let me wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great weekend.